Hey there, I'm Matt Fitzpatrick with John Hancock, and I wanted to share with you some breaking news with regards to the recently announced per diem limit and discuss what this means for planning with your clients. The new 2022 per diem numbers were recently announced mid-November 2021, and the per diem amount decreased by 2.5%, going from $400 per day in 2021 to $390 per day in 2022. This is the first time that the per diem has decreased, and this has surprised us given that many headlines have been focusing on the inflation increases we've seen this year. So why exactly did the per diem go down? In order to answer that question, we have to go back to 2018 and the Tax Cuts and Jobs Act, where the formula to calculate the per diem shifted to a chained consumer price index for all urban consumers. In 2018, applying the new chained CPI to the formula, we anticipated a decrease in the per diem. Applying the formula in 2018 to the new per diem should have gone from $360 per day down to $250 per day, but that never happened, and that's because the Tax Cuts and Jobs Act had a provision that allowed the Treasury Secretary to adjust the per diem. Thus, since 2018, the per diem has been adjusted. It has been increasing generally by $10 in most years, but now in 2022, there will be this decrease. Many have questioned whether the decrease was a typographical error. If we also look closely at some of the other numbers reported in Revenue Procedure 2021-45, there are other numbers that didn't increase and had a similar decrease. Specifically, if we look at the 2022 deduction limits for eligible LTC premiums, it appears that the Treasury Secretary for the most part used the same amounts as in 2021, except for the circled value, which also includes a $10 reduction from 2021. This is consistent with what happened with the per diem, and it should be noted that this is a new administration with a new Treasury Secretary, so this doesn't appear to be a typo. So now that we know what the per diem will be and how it's calculated, let's discuss what this means for planning. The first thing I want to mention is that here at John Hancock, because our long-term care rider is a reimbursement style rider, it is not impacted by the decrease in the per diem. Those who likely will feel the biggest impact are those who are on LTC claim and whose benefit is capped at that per diem limit. Those individuals will have a reduced benefit in 2022 compared to 2021. The takeaway I'd like to focus on is found in the bigger picture. In a time of high inflation where Medicare premiums increase by about 14%, where healthcare costs are outpacing inflation, do clients ultimately want to rely on a benefit predicated by the Treasury Secretary, or do they want a more thoughtful plan when it comes to their long-term care coverage? So I think now is a great time to explore the John Hancock Life Insurance with Long-Term Care Rider. This rider is not impacted by the per diem reduction, and that's because the benefits are paid for qualified long-term care expenses, and therefore the benefit paid is not capped at the IRS per diem limit. Thus, there's no current or future impact of the per diem on our long-term care rider. Unlike the per diem, which is currently being adjusted and does not appear to be following the formula or association with cost of care, a John Hancock policy with a long-term care rider can provide a solution that is based on the individual planning needs of the client. So let's explore how this can work and how can you help customize your client's long-term care coverage. For the sake of simplicity, we have two examples before you, both with the same $500,000 death benefit, but the ability to customize and dial the benefit up or down to suit your client's needs. In the first example, the maximum monthly benefit is $7,500. Why would someone choose this? Perhaps they're older and they don't need to account for a larger benefit. Or perhaps because they live in a region where the cost of care is low. And we know that cost of care varies not only by states, but also by region. In our second example, we show a higher maximum monthly benefit. Again, ideal if the client feels like in the future this better suits their needs. Perhaps they're younger and want to account for actual rise in healthcare inflation. I should also note that some carriers with indemnity options offer a similar option, but the benefit is still capped at the IRS per diem limit, and thus if the per diem is less than their benefit, they'll only receive this smaller pool. John Hancock's reimbursement rider may be a great solution because it offers a predictable long-term care benefit, and it offers the maximum amount of income tax-free benefits, often with a lower premium than many indemnity products on the market. Combine that with John Hancock's experience in the LTC market, and the value proposition for this solution makes it one to discuss as an option with clients. For more information on this topic or other sales ideas or concepts, please don't hesitate to reach out to myself or my sales team at the contact information listed here. Wishing you a very strong finish to 2021, and I hope to speak with you soon.